The following program sponsored by Adams Financial Concepts.
About money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth, and has a proven track record of managing long-term investments surpassing the markets in the long term. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
So here we are on Thursday afternoon, Friday afternoon, and Saturday evening talking about money. You know, it's this time of year. It's this time of year when Barron's comes out with the 10 stocks to own in 2017, the 10 stocks not to own, the mutual funds to own, the mutual funds not to own, the best buys, the worst buys. It's Barron's, it's Money Magazine, it's all the magazines, it's the TV, CNBC, the money programs. They all come out with their recommendations for the year. And usually I say it's the wrong thing to do because nothing separates the beginning of the year from the middle of the year, or a third of the way through the year, or a quarter of the way, or 3/4 through the year. It's an ongoing process. And there's nothing specific other than looking at how the year ended and where the year is going. But this year is very different. We have a change of administration, and it's a change in which we're not really sure where things are going. We're going to see things with the new administration we've never, ever seen before. There may be some reason, some changes that have to happen, but we're going to see some differences that we haven't ever seen before, and those are confusing. And so I want to talk about some of those. Looking at what this year, 2017, is going to bring, look at what the next 4 years are going to bring, because we're going into some economy where we don't really know the impact. You know, the song at the beginning of 1929 that was written and became very popular was "Happy Days Are Here Again." In some ways, it feels like that again. Happy days are here again. And of course, you know how 1929 ended. It did not end very well. I hope, and I really hope, that we don't have the same kind of thing. I don't believe we're going to have a 2008 or 2009 kind of crisis. I don't believe that's in the cards, but I do believe there's some risk in what's going forward, and we need to be able to assess those risks. I also believe we're going to see something we've never, ever seen before. Usually when you have an administration that stimulates the economy, that pumps money into the economy, you're in a recession. You're in really difficult times. You're trying to put people back to work. You have unemployment that's rising. You have an economy that's going downward. You have a slowdown. You have a recession. But what we're seeing, what the Trump administration is talking about doing, is doing a stimulus package, a $1 trillion stimulus package, an economy that's already rolling. No, we're not at 4%, but if you look at what's going on, it didn't start at the time of the election. It began in 2016 or 2015. We've had an economy that's been improving since from 2009. We reached kind of a bottom, and the economy's been moving up. You know, what we're seeing are companies with record profits, and they're not growing as fast as they were, but they are record profits. We're seeing cash levels at record levels. Companies are carrying those. We're seeing not only companies that are carrying record cash levels, but an administration that wants to bring that cash back into the country so that those companies will invest and provide additional stimulus over and above what the government's going to provide. We're seeing consumer debt levels, which on the average are lower than they carried over the last 40 or 50 years, with the exception of the early 2000s. Consumer debt levels are low in comparison to historical levels. We're seeing consumers that have benefited by lower oil prices. It's like oil prices were a stimulus to the economy for the last 18 months to 2 years. Unemployment at 5%. And for those who talk about 93 million people unemployed, you have to know that 93 million people are not unemployed. Actually, there's 93 million people that are not working, but that doesn't mean they're unemployed. 93 million counts the people that are retired. It counts students, counts everybody over the age of 18. Counts people that don't intend to work. It counts the families where the wife has decided not to work, or the husband is a stay-at-home husband. It counts those people as well. Real unemployment is 5%. That's historical standard. That's a very low level of unemployment. And we're beginning to see the impact of that because we're beginning to see wages rise. They're rising at close to 3% per year. That's a very high rate of increase. We're seeing housing not only recovered, but if you look at what's happening in Seattle, Seattle's an unusual market, but the lowest inventory we've seen in a long, long time of houses for sale. But we're seeing that across the country. We're seeing housing is really taking off. We're seeing the impact of 2008, 2009, when builders were not developing lots to build on. And it takes a few years for that to work itself through the regulations and the permit process to get bare land through the process, to get it through the application process, to get it through the pre-application process, to get it builder ready so houses can actually be built. That can take 2 or 3 or 5 years. You know, during the middle of the Great Recession in 2008, 2009, 2010, one of those times I had David Main, who was president of the Master Builders, on, and he talked about being 30,000 lots short by the year 2014. We're still 30,000 lots too short, or maybe even more than that, for the houses that need to be built. So that's a lot of the reason why we're seeing a shortage of inventory. But it's not just here. It's around the country. Housing is doing very well. But it's not just in this country. The world economy is improving. And that's going to continue. You know, there's an old saying that investing in the market is a lot like chess, not like checkers. It's a matter of strategy. It's a matter of contemplation. But if you look at what's happened this last year, it's looked more like the economy. And investing in the market is more a game of checkers than chess. Things are going very, very well. The economy was in good shape. It wasn't just that we had the Trump boom. What we're seeing is the impact of a year in which investments were growing and the economy was doing well, companies were doing well, and we finally see that at the end of the year when the election's over. During the election, people were talking about how terrible things were and how things were going to get worse. You know, I said at the beginning of last year that it was going to be a very difficult year for investors, but a very good year for investing. That was true of what happened. But now we're coming to a new economy, and we're going to see some real changes take place. If you look at who the appointments for the cabinet positions are, we're seeing a number of positions where the cabinet secretaries are opposed to a lot of the regulations that have gone on. And if you look at the regulations, most of the laws that are passed in the country are not passed by Congress, but are passed by the executive branch. And the original concept was we had 3 branches of government. We had the judicial, we had the executive, and we had the legislative branch, where Congress was the part of the body that was to pass the laws, and the president was to administer the country. But what's happened over the last 2 decades, 5 decades, 10 decades, I don't know how long, but what's happened is many of the agencies have passed regulations. And as Trump comes into power tomorrow, one of his promises is that for every new regulation that's passed, there'll be 2 that they roll out. And there's going to be a lot of regulations. He wanted to do a lot of executive orders and get rid of a lot of the regulations. Well, it's not quite as easy as that. The president doesn't have the power to overdo a lot of regulations. If you have a regulation, and in my industry, there's a very, very big regulation, very important one called the fiduciary rule, passed by the Department of Labor. It's not a matter of overturning that. There's a number of people that would like to see it overturned. The big banks, the big brokerage houses would like to see it overturned. The fiduciary rule is one in which they passed saying that financial advisors have to make every decision in the best interest of their clients. It's 1,000 pages long to say that. We can say it in one sentence, but the way that the rules come, that's what was. Almost 1,000 pages long. It's not a matter of the administration saying we want to do away with the rule. If they want to do away with the rule, there's a couple things that they can do. First, they can instruct the Justice Department not to enforce it. Secondly, they can go to Congress and have Congress pass a law to repeal it. Third, they cannot fund it. Or fourth, they can pass a new regulation to undo the old regulation. But when you have a regulation, you have to go through public hearings, you have to get input, and you have to answer that input. It's not easy to do, but it can be done. And we're going to see a number of those things done. We're coming to a commercial break. Don't go away, because I've got a lot more to say about where we're headed. Be right back.
About Money with Mike Adams will resume in a moment on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Did you know the 20-year annualized S&P return was 8.19%, while the 20-year annualized return for the average equity mutual fund investor was just 4.67%? That's a gap of 3.52%. It doesn't sound like much now, but it could mean the difference between retiring in comfort and running out of money. For some seniors, a gap that large could cost them hundreds of thousands of dollars and cut their retirement short. Don't run out of money. Call Mike Adams of Adams Financial Concepts today, 206-903-1019, and learn more about how you can, 1, create wealth for retirement, and 2, protect yourself from running out of money. Adams Financial Concepts specializes in creating and maintaining wealth. Call today, 206-903-1019, or log on to adamsfinancialconcepts.com. That's adamsfinancialconcepts.com.
4264.
We're back with more about money. For details on what you hear on today's show, visit adamsfinancialconcepts.com. Now, here again is Mike Adams.
So I've been talking about what will be happening as we experience the Trump administration coming into power. And some things that we have never seen before. A stimulus during a time when the economy is doing well. Normally you do stimulus packages during a recession. This time, a stimulus package, a $1 trillion stimulus package, when the economy is doing well. Secondly, the rollback of regulations. In the beginning, I believe that's going to be very positive because we're going to remove the times. If I talked about housing a little bit, the length of time it takes to get from bare ground to builder ready to begin to build property can be 2, 3, 5 years. Regulations by the federal government are going to be rolled back. Now, in housing, I don't know, but in a lot of regulations, they're going to be rolled back. There's a risk of that because they rolled back some of the regulations on approving housing once before. We got into the no income, no job, no asset loans, the ninja loans, which eventually were the breaking point that got us into the 2008-2009 recession. It's not going to show up for a while. Rolling back regulations is, in my opinion, going to be a very positive thing for the economy in the beginning. And for all the administrations in the past that have talked about it, they never have really realized that. I believe that this administration probably will realize the rollback of a lot of regulations. Positive in the beginning, questionable in the long term. The same thing with stimulus. Going to be very positive for the economy in the beginning, But already we're beginning to see inflation driven up by wages. With additional stimulus, it should drive it even more. Inflation, as a rule of thumb, is driven 1/3 by commodity prices and 2/3 by wage prices. Commodity prices have been down significantly during this slowdown period in the last 2 years. They're beginning to rise again, and now we'll start to see wages rise. So we're going to see some impact of inflation. It's going to take a while for it to show up, but that's going to happen. So 2017, I think, is going to be a good year for the economy, a really good year for the economy. We're going to see money coming back from overseas. That's going to be a stimulus. We're going to see the stimulus package of the infrastructure package. We're going to see regulations rolled back. But we're going to have some risk that we have to balance that against. One of those is the potential of a trade war. We have a president that seems to be fond of Russia and negative about China. China buys 6 times the number of American products that Russia does. Their economy is 6 times larger than the U.S. economy. Many products are manufactured in China, and you're going to hear more about that when my guest talks. And she's got a very interesting story, not just about China. That's a small part. But anyway, you want to hear what she has to say. But a trade war with China, with Mexico, that isn't going to be a significant negative. In many ways, could be passed because of the stimulus that goes on in the other parts of the economy, but it's going to impact us. And for all the people you hear on CNBC, and of course I watch that all day, it's going all day long. I don't pay a lot of attention to it. But the people like Carl Icahn and some of the others who talk about, let's have a trade war, get it over with and done with. Trade wars don't last a short time and are over with. It's not like the Israeli 6-day war. It's not like that at all. When a trade war gets started, it's like a storm that just begins with a little bit of a wind and just builds and builds and builds. Trade wars don't end. It takes a long time to get through trade wars. So that's a danger lurking out there. And don't forget, it's almost for sure that during this year, we're going to see cyber attacks on this administration. We have an old computer system throughout the government. We're going to see probably some significant cyber attacks. So in general, I think 2017 is going to be a very good year, but I think there's real clouds on the horizon. It reminds me in many ways of the dot-com time. I was really early in the dot-coms. I owned a couple stocks that were really early, nobody had ever heard of. They were acquired in the early days. I bought those because I looked at Microsoft. And Microsoft was able to expand because computer memories were growing and doubling every 18 to 24 months. So Microsoft was able to write more and more code and fill those memories. I remember buying my first computer with 100 megabytes of memory, and when I ran out of memory, I couldn't believe that I was really out of memory. 100 megabytes. I mean, that's so ridiculous. But those were the days. Microsoft was able to write code to fill memories, and memories were doubling every 18 months. Well, in the early 90s, the internet was doubling every 6 months. So it was a matter of understanding where things were going. But by the late 90s, I could see that things were going crazy with what was going on. And almost everyone knew that things were going to crash. But when was the question? Most people talked about things are really frothy, things are going to go down, but we're fully invested because things are going really well. If you look at my numbers back in 98 and 99, I underperformed the market in 98 and 99 because I was out of all that stuff. In 2000, when the market went down, I was up 38%. Hypothetical back. I can't publish those numbers, and those numbers were unverifiable It's not since I've had my company that you can verify all my numbers and how I perform. But those were the days when people knew things were going to go south. They just didn't know when. I worry as we go into 2017 that we're going to see the same kind of thing with this administration. I hope not. I hope that we have a very wonderful 2017, 18, 19, 20, 21, 22. But we'll have to see. The idea is to be prepared for what could go wrong. That's my prediction for 2017. We'll see. My guest today is Camille Colaizo. Welcome to the program, Camille.
Thank you, Michael.
So tell us about your background, and we'll get to your company soon.
Well, I'm a blind optician with impeccable taste. I've been doing this now for, over 30 years.
And it's Colaizo Optical.
It's Colaizo Opticians.
Opticians.
Right. And I based this business on my own desires, my own needs. So I really built the business on me.
So tell us what you mean.
By that I mean what I couldn't find in the marketplace. I wasn't always an optician. I was a jeweler. I wore contact lenses. I grew up in a time when there just was not that much availability for nice eyeglasses. And it was real hit and miss growing up. You could either see out of them or you couldn't. So the answer was contacts. And then what to do if all of a sudden you can't wear the contacts. And that was really my dilemma in the 70s. And I couldn't find any glasses that I could see out of. And after frustrating and after repairing antique gold frames from like American Optical in Rhode Island in the 1960s and 50s, I started to see the difference in the lenses, in the frames. And I thought, this is really interesting to me. Why is it that we can't get any consistency in the U.S. anymore? And why is it that the answer is only contact lenses and there's no cool eyewear? You certainly can watch enough Italian films. You can watch enough Fellini to look at all the cool eyewear you're ever going to want to see. But why can we not buy that here? So I decided to go to school. I decided to go to Europe. I decided to study it. And I did. And I found out that the story was completely different on the other side of the pond.
So what was the story there?
The story there was that they had really great frames and frame makers and lenses, and that contacts were treated completely the opposite as they were in the United States. Contacts in the U.S. are the be-all, end-all. In Europe, they were the treat. They were the specialty. You could wear them for sports. You could wear them to go out in the evening. But the rest of the time, your glasses were very necessary, and you were dependent on them. And there you had many, many different choices.
And here we didn't.
We had none.
Here we were going for contact lenses for everyone.
Right, and we sold all our tooling, and Rhode Island did all the tooling. American Optical did all the tooling. Ray-Ban had sold all, Bausch & Lomb had sold all its tooling to South America, only to have the Blues Brothers come back. And they had to buy all that tooling back to make Ray-Ban. So, yeah, we had given it away.
So you got started and you opened your own shop.
Yes.
So what is the focus?
The focus is that asymmetry is a beautiful thing. I've never seen a head that couldn't be made more interesting in a pair of glasses. My hunt for the first to have it in eyeglasses takes me far and wide, but my own unaided vision wouldn't find me the numbers on the alarm clock. And I like that. I'm with the people. I would never buy glasses from somebody that didn't wear them. And yet, how many places do you go into where that's the case? I want somebody that really,
Understands.
And here I feel I have quite the advantage. Quite the advantage.
So I have to admit, the glasses that I'm wearing now were supplied by Camille. And people do comment on the glasses. Stay with me because we're coming back after this break.
More About Money coming up with Mike Adams on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Creating and maintaining wealth has been the specialty of Adams Financial Concepts for over 20 years. Every portfolio managed by Adams Financial Concepts is customized to fit each particular client's objectives and risk tolerance. The client's interest always comes first in portfolio decisions. Call Mike Adams today at 206-903-1019 or log on to adamsfinancialconcepts.com to check out their AFC performance. They welcome your review. That's adamsfinancialconcepts.com.
Now we return to About Money. There's more information waiting for you at adamsfinancialconcepts.com. Here again is your host, Mike Adams.
So I'm here with Camille Collazo of Collazo Opticians. We started talking about glasses. We started talking about contacts, glasses. There was a program on 60 Minutes, and they talked about the manufacturer of glasses, a manufacturer of glasses that dominates the world market. So tell us more about that.
The manufacturer you're referring to is Luxottica.
What's that?
Luxottica, out of the Bassano region in Italy, in Milano. They control perhaps 99% of the world's manufacture of eyewear. What is Luxottica? Okay, first, before we say what Luxottica is, we should probably talk about frame making in late 1700s, 1800. This is something people, mostly farmers. In Italy, it would be the people in the Bassano who are, when they're not making Prosecco, or they're in the Veneto, or they're not growing grapes, or they're not farming. In the off time, they would carve frames. We could take that to Japan, to Fukui. You know, when they were not brewing beer, or when they were not doing something else, they were making frames. Now, Luxottica controls, because they have the access to acetate, the plastics that we use to make plastic frames. And these are sold by the kilo. You can probably cut 20 frames to a sheet. The machinery is old World War I machinery, controlled by a company called Mazzucchelli. And they decided to take all the production to China. What Luxottica has done is made an umbrella for all the brands. So whether it's Gucci or it's Fendi or it's Kate Spade or it's Marc Jacobs or whatever it is that's a brand, then they have taken all of those labels. When I started in this business, Italy liked a label and a signature and an initial on their frames, and I was horrified. This is the 80s, the mid-80s. I thought, oh, how gaudy. I hope this never happens in America. And my Northern European friends were saying, oh, it will never happen in your country. It's never going to happen in your country. Well, guess what?
It did.
It did. And so people in the secondary, in the tertiary markets, because this is not haute couture. This is for the masses. And they feel that this is something of value and it's worth something, and they have a label on it and they can buy it. For me, this is not interesting, because what it is parts. Fronts, parts with an initial on it. You can put this piece with this piece with this piece with this piece. To me, this has nothing to do with frame making.
And I understand that. It's like that in the financial services business too, with the big brokerage firms. They just, a lot of pieces all go together. But anyway, okay, back to the story.
So they have taken the production to China. Now you have to look at the rules for the EU. I asked my Belgian friends, I said, so what does this mean at the end here when you say it's made in Italy, and he said, well, he was laughing. He said, somewhere, Miss Camilla, you don't have enough room for all the stamps on the temple of the frame, because the rules for the EU are you can make everything on a barge. You can then ship it all the way back to country of origin, and if they just put the sleeve on it, you can then say at the final destination that it's made in Denmark, or that it's made in Germany, or that it's made in... But this is not the case.
So it may be made in China?
Correct.
And sent back to Denmark?
Correct.
And Denmark then adds one little bit to it and says made in Denmark.
Exactly.
Or made in Italy.
Exactly. And this is not, and so this is factored into the cost. It's factored into the goods and cost of goods, and it's something I don't think the public thinks about or is aware of. Where are these things made? How are they made? And so on and so forth.
I'm sure they're not aware of it.
Right. Right.
So you don't use Luxottica.
No.
So where do you get your glasses from?
I have always gone to Europe or to Japan or to Australia. From start to finish, I need to see your factory. I need to look at what you make and how you make it. So I am in a higher price point, but I am also seeing the control of the product. The products must be made there, and I have to see that. So I trade with Belgium, Denmark, France, Italy, Spain, Australia occasionally, and Great Britain.
And you find specific glasses.
Yes.
And you try to fit the person or fit the glasses to the person. Tell us some of those stories.
Well, working with heads for as many years as I've worked with heads, they come in all sizes and shapes. So I am definitely, somewhere a designer is a designer is a designer. They design for themselves. So, where are the biggest people in the world? Well, they're in Northern Europe. If I'm going to fit my Seattle people, I'm going to go to Northern Europe. I'm going to shop in countries where the light is similar to ours. We live in really flat light, low light. That's going to be great for Scandinavia, for Belgium, for England. Where am I going to find big things? Where am I going to find small things? People often will go on a vacation to Italy and come back with these glaringly gold frames and then go, oh, I love them over there, but I don't like them over here. What's wrong? Well, we don't have the same light. Mm-hmm. We don't have all that sun. So, I will see certain manufacturers because they make really large frames. They make big bridges. They make long temples. They have the right colors for all my Scandinavian-based population. And I might go to other countries because they really specialize in large bridges, long noses, close-set eyes, wide-set eyes. It's all different. It's all different.
Every individual is an individual.
Yes. Yes.
And so if you really want to have a really good pair of glasses, you get a glass that fits you. Would you say that?
Oh, for sure. And not just for the aesthetic. What about the optics? Mm-hmm. What about what you're putting in it? I look at people who come in and their glasses are broken or they're halfway down their nose, and I'm like, what are they seeing? Because they're not even seeing out of the right portion of the glass, which is going to make so much difference. So much difference.
So let me ask, if we get into a trade war with China,
yes,
what impact do you expect that to have in your industry?
For the chains, for large chains, this is going to have a huge impact because if they slap a high tariff on that, well, there's all your manufacture in China for instance, Luxottica goods. This would be middle price range goods, for sure, to low end as well. So no, their prices will jump. So their market that they're targeting, their frames could possibly become unaffordable for them.
And that means it's a complete shift into different products, different different qualities?
Yes. Well, you won't be able to have that rollout, that format, that chain format. You would not be able to have that. You would have to become much more creative and much more, I would think the retailer would have to become much more individualized.
So it will have a significant impact on your markets.
Yes.
It's not just putting the squeeze on them. It's putting a squeeze on us as well.
It would put this squeeze on the American consumer. The American consumer buys a lot of eyewear that is made in China. They may not realize that, but they do. My model is not going to shift because I don't buy anything made in China. It's a completely different marketplace. It's a completely different market.
Well, thank you.
You're welcome.
Thanks for being on the program. Thanks for the insight. Thank you for the glasses, because my glasses are from Calizo Opticians. I'll get it right this time.
Thank you, Michael.
So thanks for being on the program. I want to shift back and talk about, for one thing, about my returns for 2015 or 2016. I haven't gotten used yet to this being 2017 instead of 2016. So in 2016, I underperformed the market. Not unusual that I would have a year where I underperformed. I had a year in 2007 where I was down 10% and the market was up 5.5%. But in 2008, when the market was down 37%, I was only down 31%. That's not very nice to say. But in 2009, when the market was up 26, I was up 31. When the market in 2010 was up 15, I was up 25. By 2010, I'd recovered 2007. I'd recovered that whole period of time. My clients were seeing new highs. So there's been a study that was done, and we're coming to a commercial break. I'm going to tell you about that study because I think it has an impact. And I think there's an insight here for you as you go to see your financial advisor, because I wasn't the only one that underperformed. And how do you know if a person has lost their touch, if a person is underperforming, if it's time to switch, if it's time to make a difference? I'll come back to that after the break. Don't go away. Got more to come.
Stay tuned. About Money returns in a moment with Mike Adams here on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
How do you picture retirement? House on the beach, small farm in the country, traveling the world with your spouse. The one thing you don't picture is running out of money. Retirement dreams are shattered all too often by poor investment choices, sending many retirees back to work. If you think the job market is tough now, try entering it after you've retired. Don't run out of money. Start planning now. Call Mike Adams of Adams Financial Concepts today at 206-903-1019 and learn more about how you can create wealth for retirement and, probably most importantly, protect yourself from running out of money. Adams Financial Concepts specializes in creating and maintaining wealth. Call today, 206-903-1019, or log on to adamsfinancialconcepts.com. That's adamsfinancialconcepts.com.
About Money continues. Remember the website adamsfinancialconcepts.com. Here's Mike.
So I started to talk about my returns. There was a study done by R.A. Baird back a few years ago. They talked about looking at all the mutual fund managers and finding the mutual fund managers of over 4,000 equity funds. They found 370 that had averaged over a period of 10 years an average of 1% better than the market after fees, after everything was done. A net of plus 1% on the average for those 10 years. But when you look at it in detail, 100% underperformed the market in at least 1 year, 85% underperformed in at least 3 years, And half the money managers underperformed not just 3 years, but underperformed by 5 to 10%. And 25% underperformed over 15% for a period of 3 years. That means those are periods of time when the money managers are seeing underperformance. They've been preparing for something. They've been looking at things. Their stocks are out of favor. Whatever happens, they underperform the market. And I've gone through that. I've been in the market now for 30 years, and there have been periods of time when I underperformed. Earlier in the program, I talked about 98 and 99. I underperformed in 98 and 99. 2000, 2001, my clients were actually making money when everybody was losing money. That was a fun time. I remember that time so well, I began to think that I was brilliant. And then came 2002, and my clients were down as well as the market. But, that's the humility you go through. It's a time in which you have to be really aware of who is managing your money and why they're managing and what their track record really is. Past performance is no guarantee of future performance. We hear that all the time. But what do people look at? It is the track record. And over the period of time I've been managing money, my track record is pretty, almost extraordinary. Eugene Fama won the Nobel Prize in 2013 looking at money managers and found that fewer than 7% actually do as well as the market when you look at their fees. That means 93% underperform the market over a longer period of time. Doesn't mean they'll have 1 or 2 or 3 years over, but it means over a period of time, they underperform. Dalbar's done a report. You heard an advertisement earlier in the program that the average mutual fund investor over the last 30 years has averaged 4%, when the Standard & Poor's was up almost 9%. Well, over a period of 30 years, that makes a huge difference in terms of return. Department of Labor talks about the 401k market, and a 1% underperformance in a 401k means at the end of 20 years, 17% in the actual value of the 401k. Think about what 2 or 3 or 4% does. That's where it comes down to the investor looking at the money manager, at the financial advisor, and deciding, are we underperforming for a reason, or are we with somebody who's having a temporary underperformance? For me, I underperformed in 2016. I underperformed by about 6%. I believe that we will see in 2017 and going into 2018 a recovery of that and an improvement of that. But there's no way I know for sure. There's no way to guarantee that. That's the gamble of the stock market. That's why it's a game of chess rather than checkers. The economy, I believe, in 2016 was a game of checkers. It was straightforward. Things were moving forward. I believe that the coming year, this year that we're in, and the year following this, are going to be more a game of chess than checkers. It's being in the right place at the right time. It's understanding that we face a number of risks in what a new administration will come. And I hope that we don't see a trade war. I hope we don't see inflation begin to kick up. I hope we don't see those things happening. I hope that the stimulus package moves along smoothly and keeps the economy moving for a long time. I believe, and I've talked about any number of times, I've been talking for the last 7 years, 8 years, I'm beginning to lose track of time. On the program, I've been talking about the super cycle, Standard Chartered Bank's super cycle, when they say that you have long periods of time when the world GDP outperforms the average. 1870 to 1913, that was a time when the the world GDP outperformed, driven primarily by the industrialization of the U.S. 1945 to 1970, another period of time when you had a super cycle driven primarily by the rebuilding of Europe, the decolonization of the world by the primary countries that had colonies, the rebuilding of the infrastructure in the U.S. or the building of the infrastructure in the U.S. All those things were going on in 1945 to 1970. Standard Chartered Bank says in 2009, we started a new super cycle that will last for a good number of years, 15, 20, 25 years, who knows exactly how long, being driven by the emerging nations. By the year 2030, the expectation is that 93% of the world's middle class, 93% of the world's middle class will be in those emerging nations. Regardless of what happens with this administration, it's going to have an impact on the world. It may slow that down. It may have an impact. We may go through a recession. We may go through a world recession. Not a great recession like we went through in 2008, 2009, but we could have a slowdown. But in the long term, we're seeing an emergence of a middle class. We're seeing a middle class in China that will be bigger than the population, is now bigger than the population of the U.S. We see India, China, and the rest of the world growing. That super cycle, I still believe, is going to be there and going to be continuing. Regardless of this administration, regardless of what happens, it's the underlying force. It will come to an end. And if you listen to the program for very long, you realize that I believe that it'll come to an end not by a recession or depression, but by inflation. I've talked about that any number of times, and we're beginning to see the beginning start of inflation. Talked about it. It began in the 1960s when we saw the last inflationary period of time. It took almost 20 years to reach its peak. Will it happen again? I think it takes a long time for inflation to really go. But yes, I believe that's where we're headed. Not this year, not next year, but over a period of years, we'll see things roll that way. Anyway, that wraps up where I am. That wraps up the program for today. I wish you a very great weekend and a beginning of next week. I'll be back with more to talk about the economy and companies and where we're headed as we begin this new year of 2017. And now, have a very good weekend. I think we're almost done. We are done.
You've been listening to About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you heard today, or about Mike's investment philosophy and strategy, or if you want Mike to evaluate your own portfolio, click on AdamsFinancialConcepts.com. That's AdamsFinancialConcepts.com. The information shared on the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Friday afternoon at 3 for more About Money with Mike Adams, here on Business Radio 1300 KKOL.
The preceding program was sponsored by Adams Financial Concepts. Creating and maintaining wealth has been the specialty of Adams Financial Concepts for over 20 years. Every portfolio managed by Adams Financial Concepts is customized to fit each particular client's objectives and risk tolerance. The client's interest always comes first in portfolio decisions. Call Mike Adams today at 206-903-1019 or log on to AdamsFinancialConcepts.com to check out their AFC performance. They welcome your review. That's AdamsFinancialConcepts.com.
Business Radio 1300 KKOL,
part of the Wall Street Business Network,
a service of Salem Media Group on the NASDAQ as SALM.
The following